My name is Zara, and I need you to stop whatever you are doing right now and listen carefully. Because what I am about to share with you is not another financial trend. It is not clickbait. It is a warning that most people will ignore until it is far too late. The US dollar is in trouble. Not tomorrow, not next week, but the slow, quiet shift that is happening right now in the global financial system is something that will affect every single person who holds their wealth in dollars or in any currency tied to the dollar. And the window to prepare is open right now. But windows do not stay open forever. I learned this the hard way. Years ago, I kept everything I had saved in a bank account, cash, local currency. I felt responsible. I felt safe. But what I did not understand then is that cash sitting still is cash slowly dying. Inflation was eating it from the inside, quietly, without drama, until one day I looked at my savings and realized the number had not changed, but what it could buy had shrunk by almost a third. That lesson cost me years of effort. And that was just ordinary inflation. What we are looking at today is something bigger. The US dollar has been the world's reserve currency since 1944. For over 80 years, it has been the foundation of global trade, global savings, and global power. But that foundation is developing cracks. Central banks worldwide are quietly reducing their dollar holdings. Countries are settling trade in non-dollar currencies. The BRICS nations are openly discussing alternatives to the dollar system. Global dollar reserves have dropped from over 71% in the year 2000 to under 59% today. That is not noise. That is a structural shift, and it is accelerating. Now, I want to be clear about something. I am not saying the dollar is collapsing tomorrow. I am not here to spread panic. What I am saying is this. The smart question is not whether the dollar will crash overnight. The smart question is what happens to your purchasing power, your savings, and your future if the dollar weakens significantly over the next 10 to 20 years. And the answer to that question depends entirely on what you own right now. So today, I am going to walk you through 5 specific assets, real assets, proven assets, assets that have protected wealth across empires, across currency collapses, across generations. Not get-rich-quick ideas, not speculation. Timeless wealth protection, explained simply, honestly, and practically. Let us begin. Part 1. Gold, the memory of money. The first asset is gold. And before you say you already know about gold, I want to ask you something. Do you actually own any? Because most people who say they know about gold do not own a single ounce. They know the word, they do not have the position. Gold is not an investment in the traditional sense. Gold is insurance. Gold is what 10,000 years of human monetary history looks like in physical form. Every empire that has ever existed has used gold to store value, and every paper currency that has ever existed has eventually been inflated, devalued, or abandoned. Gold was there before all of them, and gold will be there after all of them. Here is the core reason gold matters in the context of a dollar decline. Gold cannot be printed. The U.S. Federal Reserve can create trillions of dollars in a matter of months, and it did exactly that in 2020. When more dollars are created, each existing dollar becomes worth less. That is inflation. But gold grows in supply at roughly 1 to 2% per year, the natural rate of mining. It cannot be doubled overnight. It cannot be digitally manufactured. That scarcity is permanent and structural. The common mistake people make with gold is treating it like a stock, watching the price daily, panicking when it drops, selling when it dips. This is the wrong relationship entirely. Gold is not a trade. Gold is a position. It is the layer of your wealth that does not depend on any government, any bank, or any financial system functioning correctly. Think about this. When the price of gold rises, most people say gold is doing well. But the better way to read that data is to say the dollar is doing poorly. Gold does not change. Gold is the constant. What changes is how many dollars it takes to buy 1 ounce. When that number rises, it means each dollar is worth less. Stop measuring gold in dollars. Use gold as the measuring stick. A meaningful allocation toward gold as a structural, long-term position is one of the most time-tested decisions any serious wealth builder can make. Not as a speculation, as a foundation. Part 2. Silver. Undervalued and underestimated. The second asset is silver. And this one surprises most people because they think of silver as the cheaper, lesser version of gold. That thinking is a mistake. Silver is not just a monetary metal. Silver is an industrial metal. It is used in solar panels, electric vehicles, electronics, medical devices, and water purification systems. As the world transitions toward clean energy, the industrial demand for silver is growing fast. This gives silver something gold does not have: 2 separate engines of demand: monetary demand and industrial demand. Both are accelerating at the same time. Here is something important. Historically, the price ratio between gold and silver has averaged around 47-1, meaning it took roughly 47 ounces of silver to buy 1 ounce of gold. In recent years, that ratio has stretched to 80, 90, even over 100-1. Silver has been historically cheap relative to gold for an extended period. When that ratio compresses back toward historical norms, as it has done repeatedly throughout history, silver tends to outperform dramatically. Silver is more volatile than gold. It moves harder in both directions. This means it requires patience and a stronger stomach. But for the long-term investor who understands what they own and why they own it, silver represents one of the most compelling real asset positions available today. The mistake to avoid with silver is the same as with gold. Do not chase it when it is hot. Do not panic when it drops. Own it as a position, not a trade. And if you can, hold physical silver, coins, bars, not just paper claims through financial products. Because in the scenario that worries you most, physical metal in your hand is a fundamentally different thing from a number in a brokerage account. Gold and silver together form the monetary foundation. They are your first line of defense against currency debasement. Now let us move to the assets that do not just protect wealth, they grow it. Part 3. Real estate in the right places. Land never lies. The third asset is real estate. But I need to be specific here because not all real estate serves this purpose equally. And this distinction matters enormously. If you own property in a heavily dollar-dependent economy, where mortgages are priced in dollars, where rental income is in dollars, where the entire market rises and falls with dollar dynamics, then your real estate is not a hedge against dollar weakness. You are still inside the same system you are trying to protect yourself from. Strategic real estate means owning hard, physical assets in markets that have their own independent economic momentum. Farmland, agricultural land, property in economies with young, growing populations and rising internal demand. Markets in Southeast Asia, parts of the Middle East, parts of Africa, where growth is driven by demographics and internal development, not by dollar-denominated debt. Farmland deserves special attention. People must eat. Regardless of what happens to exchange rates, regardless of which currency dominates global trade, Agricultural land produces something real that the world will always need. Farmland has quietly been one of the best performing asset classes over the past 30 years. It produces income through rents and crops. It appreciates with inflation, and it is completely disconnected from the volatility of financial markets. The core principle of real estate in this context is simple. When currencies weaken, hard assets rise in price, not because they became more valuable, but because more units of the weakened currency are required to buy them. A piece of land does not change. What changes is how many dollars it costs to buy it. Own the land. Be on the right side of that equation. For those who cannot yet invest in direct property, real estate investment trusts, REITs, focused on farmland and international markets, provide accessible exposure. They are not identical to owning physical property, but they are a meaningful starting point. Part 4. International stocks and non-dollar assets, thinking beyond your borders. The fourth asset makes most people uncomfortable, and I understand why. We earn in our own currency. We pay our bills in our own currency. Putting money into foreign assets feels strange, unfamiliar, risky. But let me ask you something. If someone living in Argentina in 2001 had held a portion of their savings in Swiss francs or US dollars, they would have survived the peso collapse with their wealth intact. If someone in Zimbabwe in the early 2000s had diversified internationally, their savings would not have become worthless paper. If someone in Lebanon had moved money abroad before 2019, they would not have been trapped by banking restrictions that froze people's own accounts. Currency crises follow the same pattern every time. People do not diversify until it is too late. And by then, the laws have changed, the capital controls are in place, and the exits are closed. Now apply that exact logic to the dollar. Not because collapse is imminent, but because prudent wealth management means never having everything in one currency basket. International stocks mean owning shares in companies that earn revenue in euros, in yen, in Singapore dollars, in emerging market currencies. When the dollar weakens, those earnings become worth more in dollar terms. Your international positions naturally appreciate. Companies in Europe, in Asia, in commodity-rich nations are businesses whose growth stories are independent of what happens in Washington. The Singapore dollar, the Swiss franc, the currencies of resource-rich economies. These are not exotic speculations. They are established, stable stores of value with long track records of holding purchasing power. The practical step here is simple. Open an internationally diversified brokerage account. Look at global index funds that hold non-US equities. Do not wait until the moment everyone is panicking about the dollar to discover that all your assets are dollar-denominated. Diversification is not exciting, but it is the foundation of financial survival across every kind of market environment. Part 5. Bitcoin and hard digital assets. The new layer of monetary sovereignty. The fifth asset is the one that will generate the most debate, and I want to address that directly before I explain it. Bitcoin is controversial. It is volatile. It is misunderstood by many and overhyped by some. I am not here to tell you Bitcoin is the answer to everything. I am here to explain why, within the specific context of a declining dollar and a questioning of the global monetary system, Bitcoin occupies a unique and important position. Bitcoin has a fixed supply, 21 million coins. That number will never change. It is written into the code, maintained by a decentralized global network, and cannot be altered by any government, any central bank, or any single institution. In a world where the primary concern is currency debasement, where the fear is that the money you hold is being quietly diluted by endless printing, a genuinely fixed supply asset is a remarkable thing. This does not mean Bitcoin is without risk. It is highly volatile. Its history is short compared to gold. Its adoption, while growing, is still incomplete. These are real considerations. But here is the thing. Bitcoin is increasingly being held not by retail speculators, but by institutional investors, sovereign wealth funds, publicly traded companies, and even national governments as a reserve asset. El Salvador made it legal tender. Several U.S. states have passed legislation recognizing it as a reserve asset. BlackRock, one of the largest asset managers in the world, now offers a Bitcoin ETF. The conversation has changed, and it has changed because the underlying logic, a mathematically scarce, borderless, unseizable, non-inflationary asset, makes sense in a world worried about fiat currency weakness. The mistake most people make with Bitcoin is treating it as a lottery ticket. They buy it when it is already at a peak, driven by excitement and headlines. They sell it in a panic when it drops 50%. They never give it the patient, long-term treatment that transforms it from speculation into a position. Think of a small, disciplined allocation. Not money you cannot afford to lose, but a meaningful position that you hold with a 5 to 10-year time horizon. Not checking it every day, not reacting to every headline, owning it the way you would own gold, as a structural position in a world where monetary rules are being rewritten. The 5 assets together, gold, silver, strategic real estate, international stocks and non-dollar currencies, and Bitcoin, are not a magic formula. They are a framework, a diversified, thoughtful, historically grounded framework for protecting and growing wealth in a world where the dollar's dominance is no longer guaranteed. Final warning and closing. Here is what I want to leave you with. The people who will look back on this period with regret are not the ones who tried and failed. They are the ones who understood the warning, felt the urgency, and then went back to their routine and did nothing. Inaction feels safe, but in a world of structural monetary change, inaction is the highest risk position of all. Because the cost of inaction is not a loss you can see on a single day. It is a slow erosion of purchasing power, of savings, of financial security that happens quietly, year by year, until one day the damage is already done. You do not need to do everything at once. You do not need to be wealthy to start. What you need is clarity. You need to understand what you own, why you own it, and what role it plays in protecting the future you are working toward. Start with one step. Buy your first ounce of silver. Open an internationally diversified account. Research Farmland REITs. Read about Bitcoin with genuine curiosity rather than dismissal or blind excitement. Just start. The storm is not here yet. The sky is still clear enough to prepare. But financial storms do not announce themselves with enough warning for you to act comfortably. They announce themselves when it is already uncomfortable to act. And then they arrive before you are ready. My name is Zara. I have made the expensive mistakes so I could share the honest lessons. And the most honest thing I can tell you today is this. The best time to protect your wealth was 10 years ago. The second best time is right now. Do not wait.